Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. Individual stock pickers got slaughtered in 2021. Other than a few bright spots, buying into the S&P 500 and Nasdaq 100 yielded significant returns. But that's all about to change in 2022. We expect supply chain issues to drag well into 2022, putting a damper on earnings in the first half. From there, higher interest rates should pressure this year's winners, forcing money to rotate into small caps and financials. Despite 24-hour shifts and push from the White House, ships clog the port of LA, with more than 100 waiting to dock. Sure, demand will drop in Q1. There are still over 100 ships to process. Chris Chase, Director of Business Development for the port, said it will process 3 million more containers this year. On an average month, the Port of LA handles around 800,000 during busy times. Right now, that number is closer to 900,000. Heavy demand continues to push up transportation costs, as historically high marine shipping rates returned this month. Combined, these issues won't ease pressure on corporate margins through the entire first half. On top of the aforementioned problems, the Fed plans to end its asset purchase program in Q1 or Q2 of 2022. And raise interest rates sometime between Q2 and Q3. While that's great for banks and financials, we expect it to mute gains for markets. The Fed will continue to raise interest rates until it sees inflation subside. And while most of the Fed board members expect 3 rate hikes next year, we could see them get more aggressive if needed. Higher rates mean companies with heavy debt pay higher interest expenses, and stocks that investors buy for dividends, like utilities, should drop. While we expect the high-flying tech meme bubble to burst, not every company will get slaughtered. Some companies, like Apple, are incredibly cheap on a valuation basis. Even Zoom, the poster child of COVID stocks, generates a nice profit in cash flows. We think the biggest risk lies with social media companies like Snapchat that only recently hit positive cash flows from operations. The bottom line is this. Laggards for any given year often outperform the broader market in Q1 of the following year. Given how small caps and financials underperformed the broader market and the favorable environment, we expect money to rotate into these sectors in the coming months. Our favorites include regional banks and Citigroup, along with the broader small cap index, which have higher exposure to financials than the large cap index SPY. That's all we have time for today on The Juice. Click, follow, and subscribe to The Juice email for your daily dose of market minerals.